Welcome to the Real Estate Investment Podcast with Colin Murphy, a podcast for anyone who wants to learn more about building a rental property portfolio with strong cash flow and stable tenants. Here's your host, Colin Murphy.
Hey everybody, this is Colin Murphy and welcome to podcast 32. So I was at an investor conference in Tampa recently, just finished up 10 days ago. I was one of the hosts at it. It was a great time. I met about 150 different people. Shout out to Kathy Fedke and Rich Fedke of the Real Wealth Network for organizing it. And, during the first 2 days of the 4 days, we met companies from all over the country that were doing what we do, basically property rehabbers that were fixing properties, selling them to out-of-state investors that were very, very good at it. We compared notes, best practices, market information, really, really useful couple of days. And then on Sunday, it was all about meeting the buyers, meeting the investors, people that want to build rental portfolios. I spoke in front of, I think, about 150 people in the Hyatt Hotel in St. Petersburg on the Saturday, the 10th of February. And then on the Sunday, we took 55 of them on a bus tour around all our properties in northern Tampa. And it was a lot of fun. I met a lot of great people. And if you're listening, you know who you are. Thanks for tuning in. But one of the things I noticed on the sidelines, particularly among the newer investors, and a lot of people that I met that weekend were newer investors looking to get started with their rental portfolio, is that they were worried about what might happen in the near future. They're worried about what might happen in the property markets. Some were worried that prices that were going up too fast. Others worried that prices were about to fall really fast. Others were worried that rental yields were getting too tight, or that interest rates were about to jump up. Okay, and I'm sure a lot of the people listening have worried about that stuff as well, and very understandably so. So I'm going to dig into that issue today, and if there's one key theme, it would be that time in the market is much more important than timing the market, okay? Time in the market is much more important than timing the market, all right? And shout out to Eula from New York who coined that sentence for me during the lunch last week. So, I think a guaranteed way of being stuck on the sidelines or being unsuccessful in real estate investing is to plan your investments around timing a downturn in the market. It can be very destructive. It's incredibly different to pull off. And if you do pull it off, a lot of the time it's just blind luck that you got in and out at the right times in the cycle. And to kind of illustrate how, just how long that you keep these assets, that's what makes it all work. That's what makes you rich. I'm going to try and do a thought experiment with you. And now these thought experiments, they normally work best when you have your eyes closed. But I know a lot of you are going to be driving or walking while listening. So we're going to keep our eyes open to avoid accidents and sore heads, all right? So just imagine for a minute that you're back in 1998, all right? Let me paint a picture for you. 1998, some of you that feels like a lifetime ago, others it doesn't feel like that long ago at all. So what happened then? Google was founded in 1998. France won the World Cup in France. I remember that very well. In Ireland, we signed the Good Friday Peace Agreement. That was a big deal. The International Space Station was just getting built. And obviously the biggest story in 1998 was the whole Bill Clinton, Monica Lewinsky scandal that dominated news headlines across the globe for that whole year. Okay, so there's 1998 in a bit of a nutshell for you, all right? So just imagine that you're back then and that you buy 10 houses for $100,000 each. All right. So $1 million worth of houses, and you put $20,000 down on each of them on a 20-year mortgage. So I'm keeping it very simple. I'm not going to get you to do anything complicated with numbers, but just picture that 10 houses for 100 each, $20,000 deposits on each one. So the rental income over the last 20 years, it's been nice, but it hasn't made a massive difference to your lifestyle. But it was sufficient to pay that mortgage, pay for the repairs, pay for the running costs, the property taxes, the property management, and leave a little bit over for your reserves and, maybe paid for a couple of vacations for you. So what might have happened during those 20 years to those 10 properties? So obviously, we had a stock market crash in 2000/2001. So those homes maybe went up in value to 120,000 and then fell back down to 95,000 again in late 2001. Then, of course, we had a massive boom during 2002 to 2006 or 7, and they shot all the way up to $160,000. So now you're feeling great. Those $100,000 properties are worth 160 in 8 short years. So you've made a lot of money on paper. But of course, the Great Recession happened, and those average values fell all the way back down to $85,000, $90,000. So like lost half their value by 2009. And you're probably a bit down in the dumps then, but you held on to them. And fast forward to 2018 or 2019, they're back up at $160,000 each again. All right. So you bought them for 120 years ago. There was a few ups and downs, like there always is, and now they're worth 160 each. But the key is, and now in 2019, you've paid off all those 20-year mortgages, and now you have a portfolio worth 1.6 million. Those 10 houses for $160,000, they're worth $1.6 million. All you spent in 1998 was $200,000. You put a $20,000 deposit on 10 of them. You paid $200,000. Your tenants paid $1.3 million in mortgage and interest payments for you. And now you're receiving about $13,000 in gross monthly rental income with no debt. How nice would that be? Owning a $1.6 million portfolio, debt-free, with a monthly income of $13,000. Sounds a lot like financial freedom, right? Certainly does to me. So, with that in mind, would it really matter if you paid $90,000 or $110,000 for those houses back in 1998 instead of $100,000? Would it really matter if your net cash flow was $200 a month or $150 a month or $125 a month? No, it's not that important. What's important is that you hang in there. You hang in there through the 2000 crisis, the 9/11 crisis, the Great Recession, the Great Recovery. You hang in there. It's your time in the market that determines that portfolio's value, not timing the market, not trying to get in 2001 and out in 2006 and back in again in 2011 and back out again in 2018. That's not what it's all about. Okay? So even if those houses were somehow worth less in 2018 than they were in 1998, just say, it's highly unlikely, but let's say they for some reason they're worth 90,000 each instead of 100,000 each. You'd still have a $900,000 portfolio debt-free that you only spend $200,000 to acquire. And that's assuming prices fall after 20 years. So, like I say, I know people doing what I do, and they're looking at prices in the places I buy, and they're just like, I refuse to pay $100,000 for an unrenovated property, or I refuse to pay $140,000 for a renovated property. That's not the point at all. Or other people might say to me, Colin, I like your houses, I like you, but I want to get $200 a month in cash flow, and your properties are $150 a month. Really, that isn't super relevant in the short term. You're in this to have somebody pay your mortgage and have inflation do the heavy work. Living off the income on paid off homes is what it's all about, guys. Real estate doesn't do much for you. Here's a alert here. Real estate doesn't do a whole lot for your cash flow in 5 years or 10 years. Sometimes you get a nice bump in your net worth during that period if the market's moving in your direction, and other times you don't. But it's all about hanging in there. Keep saving your money and put it to work on those deposits. Better still, put other people's money to work for you, because that's essentially what a mortgage is. You all know that, smart, some people work for money. Smart people make money work for them. Really smart people make other people's money work for them. So that's what it's about. You can absolutely be too late to a market if you've a short time hold strategy and you're not adding any value. You can be too late to market if you're just getting in and out in a year or two. But if you have a longer hold time, like 10 years plus, market timing just isn't that relevant to the real estate investor. It really isn't. Just focus on how much liquidity is in the market. Have you good access to job? Are the rental yields solid? And timing just isn't your deciding factor. Once you look at a market and if you decide it's fundamentally solid, like is the population growing? Are there enough jobs there? Is it affordable? Is there a good mix of owner occupiers in there? Can people afford mortgages? Can people afford the rents? Does it make sense? Is there too much speculation? Just decide on the fundamentals of the market. And once you can kind of decide that a market like Tampa has all the fundamentals in place, then just don't fret too much about whether property is paying you $150 a month or $190 a month. Certainly don't invest in a property that's cash flow negative. That's makes no sense. I mean, it has to pay its way. It has to be paying for itself. But whether it's throwing off, 3,000 a year after your mortgage or 5,000 a year after your mortgage, it's not going to make a big difference to your net worth. What makes a big difference is when you get older and those mortgages are paid off. That's what makes a difference. And I know a friend of mine, Keith Weinhold, some of you will certainly know him or have heard of him. He has this great, way of explaining how real estate pays you in 5 different ways. All right. And if you can bear with me for another minute, I think this will be worth listening to. So let's just take that $100,000 property again. You bought a $100,000 single family home with a tenant in it. It pays for itself. Your rent income exceeds your expenses. Okay. And let's pretend that, the first way a property will pay you is appreciation. Okay. When you get it, it's great. When you don't, it's okay. But let's say your property appreciates from 100,000 to 106, which is pretty much in line with real estate's historic appreciation rate, is about 6%. It's higher than that right now in Tampa. But so you've received a 6% return, went from 100 to 106. But that you've got that on both your $20,000 deposit and on the 80,000 that you borrowed from the bank. So your 6,000 gain is really based on your down payment. So 6,000 as a percentage of 20,000, that's magic. That's the magic of financial leverage. Means your return is 30%, 6,000 over 20,000. So you got 30% on appreciation from getting from 100 to 106. Number 2, cash flow. Let's say your monthly income is $150 after your mortgages, your insurance, your maintenance, taxes, management, etc. That's 1,800 a year. Doesn't sound like a lot of money, but it's decent. But that's 1,800 again. You only spent 20,000 of your own money on this. So 1,800 divided by a $20,000 down payment, that's your cash on cash return. That's another 9%. We're up to 39% now with appreciation and cash flow, but we're nowhere near finished. The third one, loan pay down. Unlike your own home, your private residence, your homestead, where you have to pay the mortgage, with rental properties, as long as you've got a good manager, your tenant pays the monthly principal on the loan and they pay the interest on the loan as well. So at a 6% interest rate on a 30-year mortgage, that's $900 the tenant pays for you every year on that loan principal. I'm not even talking about the interest. They're paying $900 off your loan principal every year. So divide that by your 20,000 of your skin in the game, and that's another return of 4%. And again, that's very conservative because the amount of the principal that they're paying goes up every year as the interest goes down. All right. But 4% a year from year 1. Okay. What's number 4? So we've gone through appreciation. We've gone through cash flow. We've gone through loan pay down. What else? Tax benefits. There are a ton of tax benefits to being a property landlord. You've got interest deduction on your mortgage. You've got the ability to defer capital gains tax with 1031 exchanges. A lot of people do that. You've got tax depreciation, which can shelter part of that rental income you're getting. I can't give you an exact number for that because it depends. Everybody's situation is different. Depends on your own tax returns and what ways you're getting your income. But let's conservatively call those tax benefits another 5%, like $1,000 a year, 5% of that $20,000. That's conservative. You can get $1,000 in tax deductions from a rental property. Number 5, inflation hedge. That's a misunderstood one. I think everybody gets that if you leave money in a bank and inflation is very high, the value of those savings, degrades over time. You can buy less stuff with those savings because inflation is making everything else more expensive. That's pretty easy to understand. But the flip side is also true. If you've got fixed interest debt, inflation also makes that easier to pay it back. That $80,000 loan in 2019 is a lot easier to pay back in 2029 or 2030 when inflation has made everything else more expensive because your wages and your prices just escalate over time. Your rental income escalates over time. Okay, so your bank only wants to be repaid in the nominal dollars while your tenant pays the interest. They don't want to be paid. Your bank doesn't want inflation adjusted dollars. They want a fixed amount every month. So that benefit is at least another 3% a year, just that inflation benefit. So now let me summarize. We've got 30% on appreciation, 9% on cash flow, 4% on loan pay down, 5% on tax benefits, 3% on inflation hedge. So your total first year return on investment from that $100,000 property that you put down $20,000 of your own money on is 51%. Okay, that's what makes ordinary people extremely wealthy, getting those kinds of outsized returns. I mean, you put your money in an exchange traded fund or the money markets or something like that, you get 2 or 3% a year. And sometimes the markets go up and sometimes they don't. But with rental properties, which I think should be part of everybody's, pension portfolios, you can get tremendous returns. Okay, and even if you didn't have the appreciation element of that, and you still have the cash flow, the loan pay down, the tax benefits, the inflation hedges, regardless of market conditions. You take the appreciation when you get it, and when you don't get it, you don't fret, because again, it's all about your time in the market. Okay, so I hope that's useful. I hope that's given you something to think about, and if it makes you a little less worried about jumping in, then I've done my job, because it's really all about getting started. It's all about accumulating assets and holding on to them. Don't fret the short-term gyrations in the market. Don't fret them. Just buy a good property from a good operator in a nice area that makes sense on a fundamental level, that you can see there's going to be long-term demand in those areas. So I'm not talking about speculative condo towers with water views and sky-high HOA fees. I'm talking about just buy suburban properties with lots of owner-occupiers, lots of renters at affordable prices. Put down a good deposit. Don't remortgage it when you get appreciation. Just keep the same mortgage for the length of it. Pay it down quicker if you feel like it, but get some assets accumulated so that when they're paid off, you'll be earning that $10, $11, $12, $13, $14, $15,000 a month just from your rental properties. And all you've done is bought a bunch of rental properties over time, and you're really using other people's money to get wealthy, plus the power of, inflation hedges, loan pay downs, tax benefits. I mean, you're using other people's ingenuity, other people's money, other people's laws to get rich. You don't need to be smart to be wealthy in real estate. I'm certainly no smarter than anybody else, but real estate is a really good way of living a good life and having fun. It's a very enjoyable job. So hopefully I've given you some food for thought there. Any questions, by all means, reach out to me. You can get my details on the show notes. I appreciate your listens, as always. If you can give me a review, I'd really appreciate that too. A 5-star review helps me get my name out there to a wider audience. But I'll get a great guest on for podcast 33. But I just wanted to do a short podcast before the end of the week to talk about this theme. It's been at the back of my mind for a while, and wanted to put it out there. Hope you like it. And look, that's it from me today. You enjoy your time. This is Colin Murphy signing out. Take care. This recording contains general information relating to the real estate market, and it is for educational purposes only. Buyers should always seek appropriate legal, tax, and financial advice from suitably qualified professionals before entering into any real estate transaction. Actual returns from rental properties will always vary from person to person and deal to deal based on unique circumstances. And while we've no reason to doubt the validity of comments of any guests on our show, we do not warrant their accuracy. Thank you.
Thank you for listening to the Real Estate Investment Podcast with Colin Murphy. Don't forget to hit subscribe on iTunes, Stitcher, and Google Play for new episodes and tips on building a rental property portfolio.